Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio. Our next guest is a returning guest to the program. He is Tom Whitman, the president of NASDAQ OMX PHLX. Tom, welcome back to the show.
Thanks for having me back. Good to be here.
I'm glad we can finally get you on in person. It's always fun to get people in the same room and chat with them face to face. So we're just going to dive right in here. And, one of the things I think that's really interesting, what you guys have done at NASDAQ and PHLX is obviously you embraced a maker-taker with NASDAQ from the beginning, and now you're slowly introducing that into PHLX as well, which has always been a traditional model. So let's start off a little bit about why you decided to add that kind of dual model to PHLX as well.
Okay. It really came down to looking at the busiest options to trade in the U.S., starting with spiders, and looking at, Philly's ability to actually stay at the inside on the NBBO and have any size related to that. And without that, you can't attract order flow. So it really came down to, in my opinion, which I've talked to everybody, I call it the math problem, where traders were being charged a transaction fee, plus we had payment for order flow in that product. And you're competing against other exchanges that were paying market makers to make a market. So if you take that calculus out of the equation, you start paying those market makers. We were able to get those market makers and participants to be on the inside, tighten it up, and add a lot of liquidity to that product. So we saw market share in that product go from single high-digit market share to 25, 26% really overnight in a couple of days. And we watched it perform, and we decided to roll that out to more products, which we did the following month. 51 products there as of last night. We added 5 last night for today, so there's 56 products, and they're performing very well. So the real story, I think that's there is the options that we moved to this program. The combined market share of those issues were around 11%, and now it's above 25% for those products that are in that offering.
It's interesting to see how these things kind of ebb and flow. A few years ago, maker-taker was all the rage, and everyone thought it was going to become the dominant model in the option space. This time last year at OIC, I did an informal poll, and it seemed like maker-taker had plateaued. And I remember even asking Adam, who was here last year, how it would kind of shake out. And the consensus from most of the heads of the exchanges is that maker-taker would probably settle out around 20% of the overall business. And now it seems this year, all of a sudden, maker-taker is back on the upswing again. You guys have added it. ISE is adding it. So I'm kind of curious now. You have dogs in both fights. You have maker-taker exchange and a hybrid exchange. So I'm curious where you think this is going to settle out now. Obviously you think maker-taker is on the upswing. So do you think we're going to looking at a 30, 40, even maybe 50-50 market coming up down the road?
Well, so, you're right. We run these two different models, and I think last year when you would talk to people about make-take, it was about price time, and I think the part that we've capitalized on the Philly model with this is the liquidity. In most, at least in options, a little different than equities, there is a lack of liquidity in the environment where you're just trying to be the first market maker at a price because there's less incentive for the second and third guy to be there. So what really makes the Philly model roll right now is the liquidity on the inside. You hear a lot of people complain about the pennies and the lack of liquidity. I think we've brought liquidity to that game at the same time. So we've got compressed spreads and increased liquidity. So, I've got, obviously a little bit of a different opinion. Last year I did think that there was going to be a set of names that would work better than others. And, we're at 56. And I honestly have a lot of people ask me, how far does it go? We will keep adding names if it makes sense to add names. The economics work. And so I don't know what the end game is. But obviously the market share in these products being 25% just on Philly and our other model, NOM, having decent market share in those names. We probably own upper 20% market share in those products, so it's obviously working well for us.
Speaking not just to maker-taker, but obviously the dynamics of the space have changed quite a bit lately. We have a new entrant just came in a few months ago, BATS. I'm curious, as you guys were the previous newest entrant with NASDAQ OMX, what's your opinion of the BATS market? Do you think there's a niche for them to carve out? Do you think their combination of pricing and that ownership model is going to work for them?
Ownership always helps. They basically copied, the structure of NOM. And, if there's nothing real unique there, they're adding names, so it's too early to tell how well they'll do. but they probably need to differentiate a little bit more, in my opinion, to get there. I mean, they've got an attractive low make and a low take. So, it'll take some time, and they're rolling out symbols, but we'll keep our eye on them.
I was curious about that as well for you, because obviously PHLX kind of got that ball rolling with the ownership model. Everyone saw that it worked very well for you guys. People have since jumped into that fray with different levels of success. BATS obviously just did it. Amex is in the process of doing it right now. So I'm curious, A, what you think about people kind of aping that model that PHLX used so successfully, and B, if every exchange group is adopting this ownership model, it's the same handful of liquidity providers and order flow providers who are buying into all these exchanges. If they have a piece of every exchange, doesn't it kind of dilute the value of that ownership model to these different exchanges?
Yeah, that's true. I mean, it's, you can only spread your order flow, so far. There's a lot of competition. There are a lot of option exchanges here. There's, rumors of new entrants. And, I think in the end, the SEC, we talk about the fee caps, I think they're going to have to take a look at how that plays into capping fees too, because ownership has some economic value in where order flow is routed. So, in the end, I don't know if these guys can spread them. They only have so much order flow. And, as you add exchanges, you can only go so far. And all the exchanges that want ownership, they can only give so much away too. So I don't see this lasting too long. It'll be spread too thin.
Speaking of BATS and new entrants, I'm hearing a lot of familiar refrains about BATS that I heard when you guys launched as well, which is the new entrants to the space are coming in and kind of taking advantage of the new models to be able to almost cherry pick order flow in a way. I mean, the guys who are the traditional exchanges say, hey, look, we're here, we're putting up quotes in these deep 100 delta options, we're putting up quotes in these, very illiquid names, and these new guys are coming in and listing front month, a few months out in like the most liquid names, and pretty much anyone can do that, but it isn't really additive to the business. And I'm starting to hear some grumblings about there should be some sort of, minimum quoting requirement for new entrants in the option space. A, what do you think about, the whole cherry picking criticism? And B, what do you think about some sort of mandatory quoting requirement for everyone in the business?
Yeah, I mean, as far as cherry pick, I think that I'm a little less concerned about that, but I do share the same thoughts about, the market makers are very critical to the option space, and it's something that I'm looking at with a non-platform of maybe creating a classification where they are true market makers and they're providing liquidity up and down all the classes, and then treat them a little bit different. What does that mean? Maybe you pay them a higher rebate or do something like that. But I think we still have to have those incentives for those market makers to stand in there all day long and have high quoting requirements and spread requirements, especially at the opening. So I kind of share that vision. We obviously have that on Philly. Don't have it on NOM yet, but considering doing something like that.
Because you kind of have a dog in both camps there. You have the traditional exchange, which has that burden, but you've also launched a new exchange, which can take advantage of those two things. So if there was a minimum requirement, it would maybe make it easier for PHLX, but a little more difficult for NASDAQ, obviously. So it kind of would be maybe a win-lose for you guys on both fronts there.
And they're the same players. We've got a lot of the same players in both venues, so.
Talking about concerns people have, I hear a lot these days. Whenever I mention PHLX to anyone, the first thing people bring up to me these days is the dividend trades, and how they're just going up with such frequency. And these obviously aren't new; they've been around forever. We used to see people put them up on the floor when I was on the CBOE, back in the '90s, and they obviously were not to the degree they are now. They're probably a few thousand contracts here or there. Now they're in the millions. But there's a lot of concern, and frankly, we see it a lot on our site too. Some beginner retail guys will come in. They're starting to learn about options. They're starting to learn about order flow and tracking open interest to kind of inform their options trading. All of a sudden, they see these credible spikes, and they're writing into us saying, "What is this? What's going on? I must know what something's going on. This underlying." We have to explain it to them, and frankly, it's good for us because it gives us a lot of traffic. Mm-hmm. But there's a lot of confusion on the retail side. The institutional guys obviously know that it's kind of distortive. And, last year I think the overall industry was up about 3%, but if you knock out that dividend stuff, it's about flat to minus 0.5%. So we're talking about almost over 3% of overall volume was in dividend stuff, the bulk of it up on your exchange. So I'm curious, A, what do you think about these trades and like the criticism of them going up? And B, there's not much economic value in these trades, and there is a bit of pejorative context to them. So what do you say about people who are saying, maybe you guys shouldn't be putting up this volume of dividend trades, or if you are, maybe you should be pulling them out from the volume numbers, distinguishing them as separate types of trades?
Yeah, those they're all good points. There is economic value for those who trade them, obviously, because there's risk involved with putting those trades up. I didn't realize that you were on the CBOE one time, so they have gotten bigger. The plays have gotten bigger. They happen on the floor in open outcry. They're audible. There's fees associated with them. We do cap fees. There is risk involved. So, I understand that. My first reaction when I heard more and more about this, I thought there was a little bit of sour grapes from people saying, this, my market share in my exchange is down, and it's because of this. So honestly, that's like where my first thought were. I have not talked to retail investors and their concerns about it. I can see where that could come up. If someone somehow wants to pull those out, that's fine. But it's those trades happen on our floor. We do charge fees for them. We do cap fees. So there's obviously some value for the market makers that do them. And there 7 or 8 firms on our trading floor that do them, and they've been doing them for years. They do them on the PCOS floor. They do them on the CBOE too. The firms that do them are really they're Philly-based firms, and I think it's because they've done them forever there. Since we had a floor in options. So I think it's just history. It's the same group of guys, the same firms that do them, small firms and big firms. And I think that's what it is, because the other exchanges have caps that all look similar to mine. So I think it's proximity and history.
And one of the things that we've been talking about a lot with the various exchange heads on the program over this past couple of days, the effect of different types of volume, just the quality of the overall volume numbers that people are getting out of the options business these days, and how there has been some steps towards improving it with, the kind of voluntary best execution stuff. But it still is kind of almost a fire hose of stuff we're kind of pushing out to the end user. There's very little granularity in those numbers. It's kind of opaque. And so I'm curious if you guys at NASDAQ, OMX, and PHLX would be in support of some sort of maybe a little bit more granularity in the volume numbers. For example, pulling out dividend trades, or at least marking them as some sort of separate thing so the average user can look at, okay, this is what's going up here. And getting even deeper than that if you want, looking at crossed orders, looking at orders that are routed away from one exchange to another, but they're counted twice, and how that kind of distorts some volume distorting plays like interest rate plays and that sort of thing. There's a lot of, I think, granularity you can get into those volume reports if you start digging into them a little bit.
Yeah, so there's some of those areas would make sense, and I think that we could support that if there was demand for that. It's fairly easy to tell you if you look at our active, we post actively traded options every day. It'd be easy enough to say that these had some div related, but it's industry wide. You'd have to do it industry wide, because I said these trades go up on other floors too, yeah. And it'd be you'd have to try to pull that from all exchanges when those trades go up. There's other trades like you see flex trades, and you never really can tell what there's a couple 100,000 of those that go up every day in different issues. So it's hard for the investors to kind of see and understand cleared volume, and that there were actually flex trades that happened on a trading floor, not in an electronic environment. So.
Yeah, I think actually there probably will be a lot of support for pulling that kind of stuff out. So I think obviously even on other exchanges they don't do the volume of the div stuff that you guys do, so they probably will be willing to, I would imagine, pull that stuff out as well. Mm-hmm. Kind of have to start wrapping up here, but I would like to know before we go. A lot of our people write to us all the time wanting to know what's going on with the world currency stuff. If you can give us and our listeners a brief update on what's new with those since the last time we talked to you.
Okay, yeah, we've added some product, and it depends on what's going on in the world. That we've seen more activity in one of the currencies or not. It's staying, for me, it looks like it's across the board pretty flat, and nothing real exciting in growth there yet. Like I said, it'll ebb and flow based on events that happen across the pond in different areas. It'll have a different effect on those currencies for a couple of days, and then it kind of flattens out. So steady.
Well, that's about all I have for you today, Tom. Unless there's something that you'd like to add.
So just a couple new developments that everyone will see in the next couple of months. We've got the software built to do advanced complex orders. So right now we only do 2 legs. We'll go to 6 legs with the stock component to that, and we'll trade the stock piece on our stock exchange through our trade reporting facility, Clear Through Act. And we are developing a price improvement mechanism. So there's a crossing facility in that mechanism, and it's to provide customers with price improvement. So it's a lot like, if firms are familiar with the CBOE's AIM kind of product, it's like that, and our own little, just a twist to it. So we'll implement those in the next couple of months.
Well, that's all we have for you today, Tom. Thanks for coming on. We look forward to having you on again down the road.
Good, thanks.
And that's going to do it for this episode of Options Insider Radio. Be sure to visit www.theoptionsinsider.com for more episodes of this program, as well as breaking news from the options market, the latest articles and analysis from options experts, a wide variety of options education, And of course, our discussion center, where you can share your questions, comments, and insights with your fellow Options Insider users. While you're there, be sure to register for our monthly email newsletter, as well as our free email alert system. Our email alert system makes it even easier to stay up to date on the latest content from theoptionsinsider.com. Thanks again for listening. My name is Mark Longo, and I'll see you next time on Options Insider Radio.
Options Insider Radio was created by Mark Longo and produced by Gene Crotty. Options Insider Radio is a production of the Options Insider Incorporated, all rights reserved.